Today I'm going to be showing you guys my top 5 Australian high growth ETFs that you can buy here on the Australian Stock Exchange. We're going to be looking at each ETF in detail, and at the end of the video I'm going to be talking about which ones I personally own and why. Welcome back everyone, my name is Senan and this is Investing IQ. This channel was created to share everything I've learned so far on my short but fruitful investing journey, and to document my journey to financial freedom, and to take you guys on that journey with me, to show you guys that it's possible. I'll be sharing my strategies, my stock analysis, and also my mistakes with you guys, because I've made many mistakes since I started my investing journey, and hopefully by sharing some of them with you I might be able to stop you guys from making some of the stupid mistakes that I've already made. So without further ado, let's get into the video. Now, in my last video I talked a little bit about ETFs and what they are. Now if you missed that video, I'll put a link somewhere up here in the top corner. So we know that unlike individual stocks, ETFs are like a basket of stocks, meaning that you're buying into an already diversified portfolio with exposure to many different stocks. ETFs are usually passively managed by a fund manager, meaning that the goal of the ETF is to track a representative benchmark index, such as the ASX 200 or the S&P 500. Due to being passively managed, they are super low cost to the investor by way of low management fees. Buying low cost ETFs also frees the investor from bother of having to pick and choose individual stocks and trying to beat the market. We also know that 8 times out of 10, passively investing actually beats an active investing fund. So long story short, ETFs are a great addition to any investor's portfolio. Now there are many different types of ETFs that you can buy here in Australia. There's Australian based ETFs, so companies based inside Australia and listed on the Australian Stock Exchange. International based ETFs, so companies based outside Australia and listed on a foreign stock exchange. Currency ETF, for investors looking for exposure to the performance of a given currency relative to the Australian dollar. And finally, commodity based ETFs, so ETFs that give the investor exposure to commodities such as gold and other precious metals. Now, I'm not much of a commodity investor, so for this video I'm going to just be talking about Australian based ETFs and international based ETFs. So for this list I've chosen 2 Australian based ETFs, 2 United States based ETFs, and finally 1 Asian based ETF. Okay, so the first ETF we're going to look at is the Vanguard Australian Small Companies ETF. Now this is an ETF from Vanguard and it aims to track the return of the Australian Small Cap Index, which is a benchmark index that tracks small cap companies or companies with a market cap between 300 million and 2 billion. Now for those who don't know, market cap or market capitalization refers to the total value of all the company's shares. So it's essentially the total value of the entire business, and it's calculated by multiplying the amount of shares times the share price. And it gives an example here. So a company with 20 million shares selling at $50 a share would have a market cap of 1 billion. Now all stocks on the stock exchange are categorized into different groups, and they're known as mega cap, big cap, mid cap, small cap, micro cap and nano cap. So for the Vanguard Small Companies ETF, their holdings only consist of companies with a market cap between 300 million and 2 billion. So it's giving you exposure to the smaller companies in the Australian Stock Exchange. Now a lot of investors prefer investing in small cap companies over big cap and mega cap because they believe the smaller companies have a higher potential growth rate. They believe that maybe the small cap company can turn into a big cap or a mega cap company one day. Okay, so let's take a quick look at their holdings to see what's in the portfolio. Okay, so I'll just shoot through some of the top 10 companies. So we have Oz Materials Limited, which is 2.24% of the portfolio. Domino's Pizza, it's probably a household name in every Australian household. We have Bendigo Bank, JB Hi-Fi, and Ansell. And if you wanted to look through the entire portfolio, you can click here and see all 181 companies. Okay, so that's the holdings. Now let's take a look at the performance to see how it's performed over the last few years. Okay, so we have the ETF NAV, which stands for the net asset value, so the total value of the portfolio. And as you can see, it's pretty much identical to the benchmark index that it's supposed to track. So over 1 year, the return was 21.5%, and over 5 years, the average annual return was 12.88%, which is very solid. And the last thing that we need to look at, which is very important, is the fees or the management fee for managing the portfolio for you. So as you can see, Vanguard charge a very low fee of 0.3% per annum. Now how the fees work is it's not charged to you at the end of the year like a bill. You don't get a bill at the end of the financial year. It's taken out of your returns already. So at that rate, you'll roughly pay around $30 per $10,000 that you have in that ETF. Okay, the next one we're going to look at is the Vanguard Australian Shares ETF, or VAS. So this is another ETF from Vanguard, and this ETF seeks to track the ASX 300 index, which is the top 300 companies in Australia by market cap. Now this ETF has an extremely low fee of 0.10% per annum, which is roughly $10 per $10,000 you have invested. Alright, so let's take a look at VAS's portfolio. Okay, so pretty much all Australians will recognize all of these because these are all the biggest companies in Australia. So we have BHP Group, which is a mining company, Commonwealth Bank, CSL, Westpac, NAB, ANZ, Wesfarmers, which is Kmart, Woolworths, Macquarie Group, Rio Tinto, Telstra, and Afterpay. So these companies are all very much household names in Australia. And then over here you can see the percentage that each of those shares takes up of that portfolio. Alright, now let's take a look at VAS's performance. So if you take a look, the 1 year return for VAS is 7.2%, 5 years 10.7%, which is still very good. And over 10 years the average annual return was 7.5%. So overall the returns might be lower for VAS, but it's a much safer investment because it's very difficult for all the large banks and all the big massive retailers in Australia to go bankrupt at once. Okay, so the first US-based ETF we're going to look at is IVV. Now, we looked at this in my last video, so it's the Blackrock S&P500 ETF. Now, this ETF is based in Australia and it is listed on the Australian Stock Exchange. Okay, so let's take a look at the holdings of IVV. So we have all the big companies in the US. So we have Apple, Microsoft, Amazon, Facebook, Google, Tesla, Berkshire Hathaway, which is Warren Buffett's company, JP Morgan, and Johnson & Johnson, along with page after page of big, massive American companies that we all know. Now let's take a look at the performance. So again, the total return of the fund is virtually identical to the benchmark, which is what you want to see. Now the S&P 500 is known for having very, very strong returns over the long run. Over 1 year the return is 9%, over 5 years the average return is 14%, and over 10 years the average annual return, which is crazy, is 16%. So that is very, very, very high for an index fund. And if we take a look at the fees, we can see that they charge a very, very, very low fee of 0.04%. So overall IVV is a very solid ETF. The last US based ETF we're going to look at is called NDQ. Now this is an ETF that tracks the performance of the Nasdaq 100 in America, which is essentially all the big tech stocks in America. So as you can see, the holdings are very, very similar to the S&P 500. However, it's primarily consisted of tech stocks, so they don't have some of the big financial stocks like the big banks or Berkshire Hathaway or other big companies like Johnson & Johnson. So if we take a look at the top 10, we can see it's all the big tech stocks in America like Apple, Microsoft, Amazon, Tesla, Facebook, Google, Nvidia, PayPal, and Intel. And again, if you wanted to take a look at the entire portfolio, you just click on all and you can go through all the different pages of all the different stocks. Okay, so let's take a look at the performance of NDQ. So the Nasdaq in America is known for having crazy returns right now because it's consisted of all the big high growing tech stocks. So companies that have had an absolutely massive growth spurt over the last 5 to 10 years, and it shows here when you look at the returns. Over 1 year, the return was 27%. Over 5 years, the average return was 23.67% every year. And since inception, it was created in May 2015. So since 2015, for the last 6 years, its average return was 20.73% every year. Now, 20% a year is absolutely crazy for an index fund. To put that in perspective, Peter Lynch, who is known as one of the most successful investors by record of all time, who had an average annual return over his 20-year career of 25%. And he was seen as a unicorn for getting that 25% every year, but yet now we have the Nasdaq over the last 6 years getting 20% every year. Okay, last but not least, we'll find the fees. So the management fee for the NDQ is a little bit higher than the other ones at 0.48%. But like I said in my first video, index fund fees that are under 0.5% aren't very noticeable on your returns over the long term. Okay, so the last ETF we're going to look at is the Asian-based ETF, and this is the BetaShares Asia Technology Tigers ETF. And funny enough, it has the ticker symbol Asia. Now, this is an awesome ETF. So this ETF tracks the big, massive tech stocks in Asia, excluding Japan. Okay, so let's take a look at their holdings. Number one is Samsung at 11% of the portfolio. TSMC, which is Taiwan Semiconductor Manufacturers. So they're the company that make all the semiconductor chips for AMD, along with lots of other companies. They're an absolutely massive high growing company in Asia. Next we have Tencent, which is a game company that owns the likes of Blizzard. Meituan Dianping, which is a massive e-commerce company in China. Alibaba Group, I'm sure everybody knows what Alibaba is. JD.com, another massive e-commerce platform, and NetEase. Now, if you look down here to sector allocation, this is what I really like to see. So 27.5% of the portfolio is based in internet and marketing retail. And 20% of the portfolio is all semiconductors. 18% is interactive media and 13% is technology, hardware, storage and peripherals. Okay, so if we take a look at the performance, this is where it gets crazy. So as you can see, over the last 1 year, this ETF has grown by a massive 69.63%. Over 3 years, the index that it's tracking has returned 26%. And over the last 5 years, the index that it's tracking has returned an absolutely insane 28.97%. Now, this ETF was only created in September 2018, so it doesn't have the historical returns that all the other ETFs that we were looking at have. Now, what that means is we have no idea if this ETF can continue to grow at the rate that which we've seen, because it's only been around for a couple of years. So if we find the fees, the management fee for the Asia ETF is 0.67%. Now, it's a little bit on the expensive side compared to all the other ETFs that we were looking at. However, some investors, myself included, are happy to pay a slight premium for exposure to all the big high-growing Asian tech companies that we saw before. Now, I know all the value investors watching are probably shaking their heads, and I agree that growth is probably not sustainable over the long term. But another way to look at it is if you look at the actual technology penetration in Asia, or the internet penetration in Asia, compared to other first world countries, you'll see that there's actually a lot of room for tech stocks to grow in Asia, because only about 50% of the Asian population are actually connected to the internet and are using these services. So if you look at the potential growth for the big companies that are the holdings inside the Asia ETF, companies like Alibaba, Meituan Dianping, JD.com, Samsung, and also the biggest gaming stock in the world, which is Tencent. There is absolutely massive potential upside for owning this ETF, because there is massive room to grow for the tech stocks in Asia. Now, to be completely transparent, and if you watched my last video, you probably already noticed that I have positions in the NDQ ETF and the Asia ETF. Now, the reason I invested in these two ETFs over, say, Australian-based ETFs has to do with the type of investor I am, and to do with the industries that I like to follow and industries that I understand. I am a big believer in Peter Lynch's philosophy on investing, which is always buy what you know.
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it.
E-commerce, fintech, semiconductors and gaming are all sectors that I know and understand very well. Whereas I don't really have an interest in learning about or following utilities, healthcare and materials. So by investing in these two ETFs, I have low cost exposure to a diverse portfolio of large cap businesses that are in the industry that I know and understand, while avoiding the industries that I don't know and I don't care about. Ultimately, you should always do your own research and your own due diligence, and always have your own personal reasons for investing in anything. You guys probably noticed, but one of the worst investment decisions you can make is to buy a stock just because someone else is buying it. Alright, that's it guys. That's my top 5 Australian high growth ETFs that you can buy here in Australia. If you have any questions about any of the ETFs that I mentioned, or if you think I missed one that should belong on that top 5 list, then leave a comment down below. As always, thank you guys so much for watching. Your support really does mean the world to me. So for my next video, I'm thinking about actually showing you guys how I go about researching my individual stocks, so my active investing side. And I'm going to do an example of a stock that's in my portfolio currently, and I'm going to pretend that I'm just looking at this stock for the first time and I don't know anything about them, and I'll be showing you guys the different tools and websites that I use to do a deep dive into a company to really understand what they do and how they make money. And I'll even be looking at some annual reports as well. So if that's something you guys are interested in watching, hit that subscribe button, hit the little bell, and you'll get a notification for when I release that video. As always guys, this video is not financial advice. I'm just a dumb millennial, so this is just my opinion for entertainment purposes only. As always, thank you guys so much for watching, and I'll see you guys in the next one.